partners. We sit on the Tanara Group platform, which is owned by John Wiley in Australia. We're the performing credit sleeve, and what we're investing in is senior secured loans, primarily supporting private equity sponsors with either acquisitions or event financings. We've been very focused in terms of defensive sectors. And what I mean by that is companies either with strong contractual cash flows, with more infrastructure like payments, or in sectors where there's very strong underpinning support from either demographics, government support, et cetera. So we really like financial services companies. We like infrastructure related companies. We do like IT companies where there is, again, a contractual arrangement with our clients. We do look at some education, and we do look at childcare, albeit carefully. I think it is important to note that we actually don't do any property financing in the fund. And that's been a decision we made early on when we set up the business in terms of trying to deliver our clients a pure corporate exposure without any exposure to the property sector, which most Australians have, in other parts of the portfolio. Every deal we look at, as a lender, we do have the equity really sitting in that first loss position. So when we structure a deal, for example, say it's a enterprise value of a business worth $100 million, we might have $70 million of equity ahead of our $30 million loan. And what that means in terms of capital preservation, it means that whole $70 million has to be deteriorated before we have any exposure to our loan in terms of our valuations. It also means that equity really wears the volatility. So that means that for our clients, in terms of the positions they're getting, it's generally very much a low volatility product. And we think that, really complements, higher risk areas like equities. Looking back 10 years ago, there were very few managers in the market. What we really have seen is the entrance of the large globals. And so groups like KKR, Bain, Highbridge, Ares, ICG all coming in, plus the growth of some of the domestics like a Metrics. And what that means is that for those larger managers or larger funds, they're really competing for deals which are sort of 100 million plus. So it could be 100 million up to 500 million, for example. That really isn't the market we play in. We play in the middle market space. So we're really looking at deals from anywhere from 10 to 50 million. We think that segment of the market has so far really held its own in terms of risk return. If we look at, for example, the risk spread that we have in our portfolio, it's sitting just over 500 basis points above bills. That's exactly where it was 7 years ago when we started out. If we look at the larger end of the market where the large global and large domestic players are investing, we have seen a collapse of spreads, probably anywhere from 1 to 1.5%. So we think that we're really playing in a more attractive part of the market. I don't want to say that competition isn't going to increase. Obviously, it naturally does. But I think in terms of what we're offering our investors, we think it really is a more attractive part of the market. And not just pricing in terms of protections. When you have a lot of money chasing deals, obviously managers are bidding for the business both on pricing, but as well as terms. So terms do get diluted very quickly in the market that we're playing in that middle market segment. We do get much more traditional bank style protections again. So for risk return in terms of pricing, but also terms, we think it is a more interesting part of the market. Like every market, when markets are going up, it's very easy to be a quote unquote a good investor just because you put your money to work and it earns your return. When we do have market volatility or market challenges or economic challenges, that's when we start to see issues in portfolios. So I think today, we're sitting on 19 positions in our second fund, all performing today. And really what goes into that is a deep analysis and understanding the business risk, understanding the cash flows, understanding what can go wrong, just having 30 years in the market, understanding what has gone wrong in previous cycles. So I think what really has stood out in terms of our performance, especially over the last couple of years, has just been the ability really to turn down deals which have an element of risk that we know in a weak environment, really come to the forefront. I think we've done a good job in terms of having a broad sourcing capability. So if we look at the current portfolio, there are deals with 10 different private equity sponsors. So we're not, just following one group specifically. We do have 2 straight corporate deals as well. So I think, again, I think it's a good point in terms of wanting to build diversification, which is critical for a liquid type strategy, but also being able to source, that plethora of deals to choose from, so that you're really choosing the best investments and you're not just sort of taking whatever comes across your desk. Rates are coming down. The Fed indicated that they're going to cut rates as well, following the RBA. But in the U.S. specifically, we have seen both CPI and PPI tick up, and we think that'll continue, just reflecting all the tariff and trade policies that the U.S. has been putting through. So in Australia, in our home market, obviously we've seen weak economic numbers. Everyone is hoping for the year to turn out sort of a 2% growth. GDP right now, we're sort of at a sub 1.5. So we sort of do need a little bit of a tailwind to keep the economy going. So we do feel some economic headwinds. Inflation obviously has been very benign, but we do look at the global markets and see inflation creeping in. So I think that's really what we're concerned about. So I think there is a concern of, we're heading potentially back into a more inflationary market, in an environment where cutting rates, given the weak economy, doesn't have as much effect as it would in a high growth market. So I think there definitely are a lot of risks in the market, but I think that's also similarly what makes private credit really attractive right now. So if you can, look at our portfolio where we're getting a cash return of, mid to high 8%, quarterly distributions, low volatility, I think in a challenging or potentially volatile market, it's very appealing to investors. So I think that's what makes the product interesting right now. I'll look at 2 recent deals we've done. Both were bilateral deals, meaning that we were the only lender in the transactions. One had been a business that was supporting the buyout by a private equity sponsor of a software business. And what they do is they supply software and hardware for parking meters, with the biggest clients being the cities of Sydney and Melbourne. And this is, for us, a very attractive deal. It works from a pricing point of view, but more importantly, it's low leverage, a lot of equity behind us. We do have maintenance covenants in the transaction, meaning that we do have quarterly testing of for example, leverage, so that if the business does underperform, we have the ability to go sit down with the client. So that really is a deal that we love in terms of just that high contractual nature of the cash flows coming to us as an investor, plus the underlying counterparty risk in the business, really going against local governments. A second recent transaction we did was in the more of an asset-backed type structure, and it's supporting against a book of receivables, more of a structured debt type transaction. In that transaction, we have 25% equity sitting below us, cash equity below us, for a book that traditionally has 2 to 3% defaults. So you have, literally 10 times coverage against the portfolio. Again, a high cash return in that case, close to 6% spread over bills, plus a business where we take literally monthly repayments from that portfolio, and it's diversified against close to 10,000 different positions. So again, it's slightly different, nuanced transaction, but another example where high equity cushion, very, very steady cash flow, diversification of risk. And we think it's, we're sitting in that senior secured position, which makes it a very attractive investment. The great thing about the Fund 2 portfolio is we started investing in February 2022. So for any new investor coming into the fund, they immediately gain exposure to that portfolio, that diversification. So again, 19 positions in the portfolio, longer term growing to 25 to 30, which really diversifies the risk in the portfolio. Contractually, most loans would typically have a 5-year maturity. Given the portfolio has been maturing for 3 years, the average contractual maturity is just over 2 years. The returns in the book, again, spreads over bank bills today sitting north of 5%, plus all the upfront fees that we get paid as a manager are passed through to the fund. So investors get exposure to all the fees plus that margin. So I think for us, it's all cash pay, no pick in the portfolio. So as an investor, you're coming in, you're getting exposure to a diversified portfolio, quarterly distributions, low volatility, and just that steady cash income stream. What we do look out for is really obviously any deterioration in performance in the portfolio. The nice thing in the private markets is we get monthly or at worst quarterly financials coming back from the borrowers. So as a business, we sit down as an investment committee on a monthly basis, and we review name by name across the portfolio. So if anything starts to underperform, we have really early access to call the client, to call the borrower, and understand what's happening, and take action where needed. But fortunately, sitting here today, the portfolio is very clean, so we feel like we're in a really good position.